Hey guys, we're going to be in chapter 13. Really, we're going to go through now how do we take the payroll transactions that we've been learning about and doing, and now putting them to work in our bookkeeping. Now, this is where you're going to have to recall a lot of stuff that we've covered in the past. So this might be a little difficult, but we'll work through it. All right. So let's take a look at it. The main idea of what we're trying to do is that employers are legally required to make tax deposits on time and to report the earnings of each employee. So that must be reported. Okay, employers must pay taxes in addition to the amounts withheld for their employees. And so this is an expense for the business. So as a result of being an expense, we have to record it as an expense. Okay. So these payroll transactions, we're going to take a look at like how do we actually record them in the general journal. These are some accounting one stuff that we learned about. How do we describe them? The employer's payroll taxes, computing them, completing the payroll tax expense forms, recording the payment of tax liabilities in the general ledger or general journal, and then complete the payroll tax report. So that's what we're going to cover, but we're going to start with just understanding this. How do we analyze and journal this payroll, the payroll? Okay, so let's take a look at this. Employee earnings are an operating expense and are often recorded in salaries expense account. So what does that mean? That means that your employee, for a business to have an employee, it costs the employee something to operate the business. So that's why they consider it an expense of the business. It's not a revenue. It's not money coming into a business. It's money going out. It's money that you have to spend in order to keep your business running. So a salaries expense is an expense account used to record an employee's earnings. So that's usually what we use in order to do that. So each type of payroll liability is recorded in a separate account. So a type of deduction. So if you have a federal income tax, you're going to include that or put that into the employee's federal income tax payable. Another one is, I'm sorry, yeah, federal income tax payable. We also have Social Security tax, which is Social Security tax payable. We also have Medicare tax, which is Medicare tax payable. And then we have hospital insurance premiums, which are hospital insurance premiums payable. So you need to understand this. A company makes 4 payments per year to the state or the federal government. So we have to understand that they have to be holding this money aside every time you get a paycheck. You may get it biweekly or every month or weekly even, but the company has to pay to the government only 4 times a year, and so or they can do it 1 time a year. So in knowing that, that's going to be a liability that they have against in the company, and that won't be able to be fulfilled for a while. So let's take a look at this, how this looks. Zip's payroll register in figure 12.4, 12-4 on page 327 is the source document for the payroll. So this is what we're going to be looking at is Zip's payroll register. Okay, and you guys can look at that in greater detail. So this is what the payroll register should look like as we go forward. So here's the T accounts again. We can see that there's a salaries expense of $1,423.80 as a debit. And now all of these rest of these are credits. Why are they credits? They're credits because they're a liability. And liability, if you don't remember, increases on the credit side. This is a liability. Now, the cash in bank is decreased by $1,135.76. Now, why would you say that? Well, we have a gross salaries expense, right? Okay, but then we're only paying the salary expense is 1423.80, okay, but the actual net pay to the employees for that period of time is $1,135.76. The difference is usually in all these payables and will come out when they come due. Okay, and so you can look at in page 344 in your book to understand how all that works and how those transactions work for your book. So this is how it would look in a on your general journal. Your general journal, you should see a debit of 1423.80, and then you should see a credit of all those items to, listed out. So I should see the 102 for the federal income tax, the state tax is 28.47, the Social Security tax is $88.27, the Medicare tax is 20.65, the hospital insurance payable is 23.65, the savings bond payable is $25, and then the cash and bank that's distributed out to the employees is $1,135.76. Now, we should understand this that this was distributed in this paycheck, right? Check 186. But we need to know this that that this amount, $1,423.80, is what all this should total. Okay, all this should total $1,400, 1423.80. Okay, and because once we have a debit, we need to have an equal credit on the other side. Okay, so this all must equal that. All right, so let's take a look at how we put this in our general journal, but now we're going to have in our sub accounts, uh, we're going to have individual journal entries for each account. Now we're going to have a salaries expense of $1,350.25, and then the rest of the payables listed out with the cash and bank listed. I'm a little confused right now for a second, but we'll do it in a second. Um, okay, this is a different example. Okay, so here's a page 346. If you're looking at 346, you can see how you would actually post it now to all of the different entries or for the different accounts. So this one is a salaries expense of 1,350 and 25 cents. Then we have all of our different payables that will come due, the cash and bank credit, and now how it would look in the account. So um, it should look like this. We have a for our salaries expense account is a debit of $1,350.25, and we have then the rest of it another now this total of $34,683.10 plus the 13,050 should give me that total right there. Okay, and you're going to go through and do this for all of these. Okay, you're going to do it for the on the June 30th. We have this date. This will carry down to here. We see that it was in. We see that we got to make this now entry of it was on source document G29. So the general ledger 29 on page 29. That's what that refers to. And we're going to see that we have an entry of $100. And this 293.18 plus the credit uh, of $100 should now leave me 393. That should be paid out for this federal income tax payable. And you guys would now see all the rest of them uh, come in the same way. So we have G29. We have on general journal entry G29. We have a credit of $27.01. We're going to take that plus the 321.12 and that will give me 348.13. So I'll let you guys read through the rest of these. Same thing, we've got a journal entry, a credit that will increase that account. I have a credit that will increase that account. I have another credit that will increase that account. And now we have our cash in bank, which is a credit. Now, cash in bank is increases in the debit side, or the normal balance, where we usually find the balance is on the debit side. So when we have a credit, it'll decrease that account, okay, because we're taking money out of the bank account, and now we're going to have $18,539.01 left over. Okay, so those are the key terms that we went over. That's how you would reference your book. Today you're going to be completing problem 13-1 and the math for accounting to emphasize this point. All right, good luck, guys.